I'm hearing the same thing over and over again. Clients are scared. Clients are, their eyes are like, what the heck is going on, right? His collateral shortfall is substantially higher. His interest rate is substantially higher. He's looking at all sorts of fees. Like, it's a bit of a mess. What don't I know that can get me into trouble? And how do you, Darren, navigate around that?
Yeah, no, those are the most common pitfalls. Let's start with collateral.
I sell primarily Mass Mutual, and I'm open to the idea of IULs and that whole thing. And I have a client in particular who started a policy premium finance case, $1.3 million. He asked me to do the case for him, and I declined because he wanted IUL, and at the time didn't have a good resource, right? And his collateral shortfall is substantially higher. His interest rate is substantially higher. To change financing, he's looking at a prepayment penalty fee. He's looking at all sorts of fees. Like, it's a bit of a mess.
Yeah.
And so I was like, whew, thank God I'm not in trouble, because his advisor is certainly in trouble, but from the client's perspective. And I'm not feeding that fire. I'm just, before I do more and more and more of this, want to understand, what don't I know that can get me into trouble? And how do you, Darren, navigate around that?
Yeah, no, those are the most common pitfalls. Let's start with collateral. I have seen several other premium financing competitors' proposals, and their collateral calculation is completely wrong. The reason I say that is that one of the fundamental differences, you'll appreciate this, the difference between whole life and IUL is the whole life, you already know what the dividend is the year before. So this year, we already know what to expect. The lenders understand that as well. So when you run a collateral calculation, you run the in-force illustration, you can run it with a certain dividend assumption, which is going to give you a certain cash value assumption. Well, not assumption. You already know what the cash value is going to be. And so they'll do the collateral calculation using that number. With IUL, you don't know what it's going to be. And quite frankly, you don't know what's going to be until the policy anniversary. But the policy cash value is not going to receive that index credit for about 2 to 3 weeks after the policy anniversary, because the segment has to clear and then the policy gets credited. So the way you have to do it is you run the illustration at a 0% return assumption. You look at the cash value, you discount it 5%, and then you calculate the shortfall. Well, that's not how premium financing intermediaries illustrate from the very beginning. They will show the end of year index value after the index credit has already hit. That's why so oftentimes you hear people say, oh my God, the collateral is so much more than they told me it was going to be. Well, yeah, because the collateral assumption was that it would trigger after the index is credited. Well, you're doing the collateral calculation in the 11th month of that segment. So not only has the next year index credit not hit, the current index credit this year hasn't hit either. So they're typically understating the collateral need, usually between about $200,000 to $500,000, depending on the size of the policy. And that's where you get into trouble. So in my software, I built in there.
Ding, 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 ding.
Yeah.
Specifically, my client, 700,000.
Yeah, exactly. So it probably wasn't mostly due to the policy not performing. It was probably mostly due to whoever put that proposal together did not do the collateral calculation properly. And I would say, at least 80%, if not 90% of the firms out there do not do it correctly. And that's why the client gets hit with this big collateral call. And no one's talking about it. Nobody's talking about it until it happens. And then everyone's talking about it.
I feel grateful that I have clients that come to me with their problems. and because I wasn't aware, right? I definitely was not aware. And if I'm working with, let's say, you, and I'm interfacing with my client, and you don't plan this way, you don't model out this way, I would have no idea.
Yeah.
And that would be a really ugly day for me, a really, really bad day for me as an advisor, right?
So-called experts in the premium financing space, if you ask them, okay, when you illustrate during the point of sale, how are you calculating the collateral expectation in year 5? Not year 1 or 2, year 5. They will not be able to explain it to you. I'll explain it to you. This might be too technical, but I'll explain it to you in less than 120 seconds. In year 5, the collateral calculation is done by the bank before policy year 5 starts, right at the beginning. So it's like in the
End of year 4, after credits have been
like right around month, yeah, right around month 10 or 11 is when the lender is going to have an in-force illustration run. Well, year 4's end of year index credit has not hit yet, and certainly end of year 5's index credit has not hit yet. So what you have to do before you even sell the case, what you really have to do is take, okay, the accumulated value in at the end of year 3, plus the premium going in year 4, minus the charges, plus the premium going in year 5, minus the charges, with no index credits. And that's going to give you the surrender value that the bank is going to be looking at before year 5 starts. Okay. You discount that value by 5%. So you go 95% of that surrender value relative to the outstanding loan balance. That's the gap. Depending on the type of collateral they're going to post is going to depend on how much of that gap needs to be shored up. If it's cash or a CD, whatever that gap is typically going to be what the client's going to have to post. If it's marketable securities, it's going to be anywhere from, 1.5 times that to double that. If it's going to be real estate equity, which I don't know anyone in the country that's able to do this outside of me, except for one other guy, and it's because I introduced him to my lender. We can use real estate equity as collateral. And so all of those factors need to be looked at before the case is sold. So you got to look at assuming those, the way that I described that collateral calculation and the type of collateral, all that needs to be disclosed up front. And then if possible, it makes me feel a lot more comfortable if that client is showing me liquidity statements that shows me a minimum of twice the high point collateral expectation. So let's just say year 1, the expectation is 300 grand. Year 3 is, 500 grand. Year 5 is $1 million. I want to see 2 million in liquid day 1, because the guy that says, "Oh, don't worry, I'll have the 2 million in year 5," you got 300 grand today. how are you going to be so sure that you're going to have, 3 to 5 times that in 5 years? And so we want to make sure that the client has the net worth, has the liquidity, has the stability to be able to have that requirement today that they won't need until 5 years from now.
So I followed everything you just said. No problem. Totally get it. Why is it because the policies did not perform in the last year? Because his policy surely did not.
The reason that has nothing to do with the collateral calculation in an IUL is because when the bank goes to calculate the collateral, at that time, again, the index has not credited yet.
Oh, got it. So even if it had a stellar year, it's just not being credited. Got it. Okay. Exactly. Makes a lot of sense. So it truly has nothing to do with the performance. It hasn't credited. It's a timing issue. So if he's putting up collateral, so his collateral is due, let's say, this month, and the policy anniversary is this month, there is no credit for that. When does he get the benefit of the overage on the collateral? Does it just stay there, or can he get that back?
Great question. Depends on the lender. Usually the lender will release whatever the excess is after the index credit is hit and the policy value increases.
Got it.
Yeah. I would say, though, in most cases, if the client's running that thin on collateral, let me rephrase that. If the client's running that thin on collateral because they don't have any more liquid, that's a problem. They're cutting it too close, right? It's like if it takes 5 gallons of gas to drive through Death Valley and you have 5.1 gallons, I would not do that, because maybe your car works a little bit less efficiently in your truck and you burn up, it needs 5.2 gallons and you only have 5.1 and you only thought you needed 5. Well, I would plan to have a little bit more than 5.1 gallons in my tank, right? So that's one thing. If, however, the client has, let's say they have 10 million in liquid and the expectation is they're going to post 1 million. And so they're planning to post 1 million, and you got to post 1 million too. They post 1 million too, and then the policy's index credit hits, and now they can reclaim the extra 200 grand, right? That's not a big deal. Why would the client want to do that? I don't know. Maybe they just emotionally feel better. But leaving that 200,000 posted in collateral, it doesn't change what's happening in their securities portfolio. They can still buy, sell, trade, do everything they normally would. It's just like it has a lien on the value of it. So to me, if I got 10 million in liquid, what's 200 grand posted or reclaimed? It doesn't matter. It's going to be the same account, right?
Right. No, and it's like how, it has to do with how wealthy the client is, whether they have, if all of their liquidity is 1.4 million versus 10 million, the Death Valley example versus, they got enough money to go to the grocery store, all month long, right? So it's all the psychology of the client and where they're positioned in terms of liquidity. So totally get that. Okay. I'm going to pivot. I get how the performance had nothing to do with the collateral, but he has a policy with that really looks pretty crappy. I'm not here for us to disparage a company or not, an illustration or not. Like, you don't know, I haven't sent it to you, but how do you design to make sure that it is an optimal design? There are a bazillion ways of designing a policy, right? There's ways that you can, increase target to benefit the advisor versus, there's a bazillion ways. Now, we all, the client, the insurance company, and the advisor has to have a win, right? Otherwise, it doesn't make sense. So how are you designing these policies to make sure it's a win-win?
It's a great question. So all those variables come into play. Nowadays you can play all kinds of games and tweak these different levers within the product to capture additional bonuses that may or may not exist in reality, so that it looks better in the illustration. And that's what the game that a lot of these, especially in premium financing, that's the game that a lot of these guys are playing. And it's a BS game, because it is not reflective of how the policy is actually going to perform in reality with volatility. The product chassis itself is very close to being the same from version to version to version, but you're assuming an extra little bonus credit that's going to make the outcome look better. So how are you going to know if this thing's going to hold up with volatility where if you get a bunch of zeros in a row? That's why our backtesting software is so valuable, because I have policies that get sent to me and they say, here's how I want it designed. I'm like, I don't want to sound like a jerk, but don't tell me how you want the policy designed, because you don't know what the policy design even really looks like with volatility. Not because you're not smart, not because you're not successful, not because you're not talented, but you don't have the software I have. So I'll get sent an illustration. Looks fantastic on the carrier illustration. I'll export the data, put it in my software, run the back test. You put in volatility, you put in the floor and the cap, I extract the charges. that same policy that looks so wonderful on the carrier illustration could completely fall apart with volatility.
Totally.
Or it could perform substantially better than the carrier illustration. And that is the only way you're going to know if the way that policy is designed and built is built prudently, properly, in the client's best interest. You would have no way of knowing. So that's the vetting that we do. I just did a case. I go overkill. I do this to myself. I realize this. I ran, I think, 6 or 7 different versions of the same exact product with the same assumptions, but switched out the index account, switched out the bonus, brought in this, took this out, boom, 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 boom. So I ran a bunch of different versions of a cocktail by turning certain variables on and off. I don't do that for every case, but this particular case, I wanted to see just how big a difference, how much of a swing there was in cash value performance and income drawdown, because the advisor said, oh, I want to design this way. This is going to sound crazy. Okay, this is an accumulation and income drawdown case. If I designed it with a certain cocktail of these 3 variables, the income drawdown, I think, was $73,000 a year. If I tweak it and find the perfect magic trick cocktail with the same product, with the same target, same everything, just different index account, different participating loan rate, different this and that, the income drawdown went from $73,000 to a little over $245,000.
I believe it. But that's hindsight 2020, right? How do you pick? You have to pick the right combination of percentages of indexes today and hope like hell that was the perfect combination. You can only play that game backwards.
Yeah.
You have no idea what's going to move forward, right?
So here's what I do. I run our design. I look at 121 different actual historical 40-year periods. I look at all of them. I pick the one with the worst compounded annual growth rate. I use S&P historical data. And so whether they're going to use a volatility controlled index or this or that or whatever, the best data, historical data I have is S&P data. So I assume they're going to use the S&P index. I input the floor and the cap. I input all the charges, et cetera, and I run it during that worst 40-year period. Okay. I also run it with the best 40-year period. So I got a high and a low within 121 different 40-year periods. When I select the index and the right cocktail of all those things, I don't go with the worst. I don't go with the best. I go with one that produces an outcome somewhere between, like right around the median between the worst 40-year period and the best 40-year period. So I'm understating reality. I'm understating what I could show simply because I'm showing carrier version with a static index credit with certain assumptions. And I'm showing best 40-year look back out of 121 different 40-year periods, and I'm showing worse. So 1, 2, 3, 3 different versions. What's going to happen in the future? Nobody knows. But at least I can document in the client file that I actually showed the client there is a range of potential outcomes. It is not a guaranteed index credit, right? All these different potential outcomes could exist. So I'm covering my own butt from a compliance standpoint, so that the client can't come back and say, oh, yeah, Darren showed me I was going to pull out 100,000 and I only got to pull out 70. Well, Darren also showed you a version where you're pulling out 43,000.
Right.
So don't come to me and say I overpromised. I actually underpromised.
Right. Okay. Let me pause here for a second and see. So what's interesting with the different, you've got the plain vanilla IULs. And then you've got, all these different writers and bonuses and what if scenarios. And if it does this, then you'll get that extra bonus. Like, how much of those bonuses and those extras do you pay attention to in your modeling? Because
all of them, all of them. Yeah. So even within the same product could have different multiplier bonus options with a different asset-based charge associated with each of those 2 different bonus schedules. In my software, I can toggle. So I click a little drop down. I select what multiplier version we want to look at, and I can toggle back and forth. So you can go super aggressive one, or you can go middle of the road one, or I can switch it off and go no multiplier bonus, no asset-based charge, and go back and forth during the best 40-year period, during the worst 40-year period. So the client can see, oh, wow, look at the upside here, but what's the downside during the worst 40-year period? We'll look at that. So sometimes the product design is such that they get a huge win in the best 40-year period, but it's substantially less of an outcome in the worst 40-year period compared to the carrier illustration. But in other cases, the worst 40-year period and the best 40-year period look better than the actual carrier illustration with a fixed rate. That's a good sign, right? If the worst 40-year period with all the volatility looks better than the carrier illustration with the fixed index credit every year, that tells you that product is designed really well.
So is that like a typical 2% floor, the guarantee, or?
I run it with I can run it in a number of different ways. I usually run it with a 0% floor and then whatever their cap is. I'll usually discount the cap 25 to 50 basis points just to be conservative. So let's say the cap is 10. I'll run it at 9.5 and understate.
Understate
the reality is.
Got it. Okay. Okay. I think I'm good with the IUL and all the issues there. Let's talk about before we pivot. Any questions on the IULs? Like the whole life, I understand. I know. I feel very comfortable with all things whole life. With the IUL, is there any question I haven't asked from a gotcha, this is what's going to get you into trouble perspective?
Sure.
Not the financing. I want to talk about financing in a moment. I'm talking about like case design, IUL, how it's being modeled, only on IUL performance, not on financing.
Yep. Several things. Is a 0% floor guaranteed? Could the 0% floor turn into a negative 1% floor? The answer is no, because of the way that the 0% floor quite frankly, and the cap is created. Did we have this conversation about okay. So in a whole life policy, all right, you have a guaranteed return plus a dividend, add those two together, and that's what they're calling the dividend credit, right? Let's say the guarantee is 4 and you get an extra 2% on top of it because the insurance carrier did well, so you're going to get credited 6% dividend return in the whole life policy. In an IUL, what the carrier is doing is they're taking that, let's say it's a guaranteed 4%. They're taking the 4% that they were going to guarantee to a whole life policy anyway. They take that 4% and they go buy options contracts. So they go to Goldman Sachs or whoever, investment banker, and they say, hey, we want to buy an S&P correlated fund with a 0% floor. Goldman Sachs says, okay, premium on that is going to be per $100,000. It's going to be $14,000, right? Carrier says we don't have a $14,000 budget. We got a 4% budget, so we got a $4,000. What will that buy us? Goldman says, okay, we'll give you the 0% floor, and we'll give you the first 10 points, and anything above 10% we take. Carrier says, okay, we'll do it. So the carrier just passes that on through to the policy, which passes on through to the benefit of the client. The carrier's got no upside on anything above the cap, and they have no risk on anything below the cap. The investment banking firm has taken all the excess and has taken on all the risk. So from a sustainability standpoint, people say, well, how can the carrier afford to do that? The carrier is not on the hook for any of this. Goldman Sachs is on the hook for all of this. So Goldman Sachs is making, so let's use units of 100,000. Carrier says we have a budget of 4,000, 4% that we were going to guarantee to the whole life policy. We're going to use that as the premium to buy the options contract. So Goldman makes $4,000 right off the top. Goldman loses anything below 0. Goldman wins on anything above 10 in that example. So the floor is built into the options contract that the carrier purchased. So that's not going anywhere. Now the cap's going up and down. Every month, the carrier takes in new IUL premium and goes out and buys new options contracts. The minimum monthly budget for a carrier to do this is $30 million a month. Okay, so these are big purchases.
Oh, wow.
Yeah. So when they take in that money, they buy a new tranche, they're buying options contracts once a month, every month, ongoing. This is not a promotion of Allianz. Allianz hits that budget every 3 days. They hit the $30 million budget because they're buying options contracts to support their indexed annuities as well as their IULs.
And Allianz is a huge machine. It's huge.
Oh, yes, gigantic. So that's the way the floor is created. The cap is created because every time the carrier goes to the investment banking firm and says, okay, we want to buy another tranche of options, the options price can fluctuate. So in a given month where they go and say, okay, we want a 0% floor S&P correlated fund options contract again, what's the cost? So the cost is now $4,200 per 100,000, not 4,000. Carrier says, I don't have 4,200. I got $4,000. What'll that buy me? And they said, well, the 4,200 will buy you a 10% cap. The 4,000 will buy you, like a 9.5% cap as an example. So that's why the caps fluctuate over time, is it's based on the options budgets, what they cost. Now what affects the options budgets? What affects the caps on the investment banking firm side is based on market speculation. So during times where market performance has been higher, interest rates in general have been higher, the caps have been higher. So what we've seen over the last decade or so is caps, the average IUL cap has decreased from about 14% down to about 8 or 9% until recently. And that all makes sense because interest rates have been on the decline. So caps have been on the decline. Now the interest rates are on the incline, they're going up now. National Life Group and Allianz just recently increased their cap by 25 basis points, like a month ago. So when market is up, interest rates are up, caps are up.
Got it. Okay, let's pivot to financing. So the financing that this client got, the financing that I've done was more traditional, no prepayment penalty fee. If the premium was $1 million a year, we got the premium, the financing every single year, $1 million a year. The one that this client got, the premiums, let's just assume it was 1 million to make it easy. It was $1 million a year. He got the loan for $3 million day one to buy down the cost of the rate. So from day one, he was paying on $3 million, 3 years worth of premiums. Only $1 million was paid into the policy. $2 million was kept with the bank. So let's just address that real quick. Do you do those kind of loans typically?
I would not advise that. I understand why they do it in concept, but now you have the client with dead money sitting there that they're paying interest on. They're paying interest on $2 million in year one.
Right.
$3 million, but they're paying, $2 million in additional. In year two, they're paying additional interest on $1 million, right? And for what?
To buy down the point.
Depends on the lender. So sometimes that will make sense, but rarely does it make sense. So I'm not saying it doesn't make sense, but it depends on how much they're buying down the rate, what that is actually costing them in terms of hard dollars. And that would dictate whether or not it's good to do that or not. Now, they could borrow, in this case, $3 million on $1 million annual premium, put the other $2 million into a PDA account, premium deposit account with a carrier. And like right now, most PDAs are paying like 3.5%. So if the borrow rate is say 4, now it's only really costing them 50 basis points.
Right.
I'm looking up the bank right now. They did not have a PDA account. It stayed with the bank.
New York Life's PDA account is currently paying out 4.5%. So if you could get a 4.5% loan, then do it. You break even. and you get a lower borrowing rate. If you get a 4% loan, and now you're making 50 basis points, you get a 3% loan, right? So it's all case by case.
Well, right. And this year that might be the case, but next year that might not be the case, right? With New York Life. And so you just don't know. Now, he did have a prepayment penalty on his loan, and he was on the prepayment. He has to pay, if he moves the loan, if he refinances somewhere else, he has to pay, the bank charged him, and I forget what this is called, like putting the money aside. So the design was 7 years of 1.3 million. Since the bank had allocated, let's say $10 million, he had to pay a fee on the bank allocating $10 million for him. So if he's prepaying the loan, he's got to pay that fee in addition to the prepayment fee.
Yeah.
Have you heard of that?
Yeah. Every lender has a different way they charge loan fees. So as an example, it's a percentage of the overall loan. They do a 10-year term typically. They have prepayment penalties because they're locking up. They're committed for 10 years. The good news about that is the client only gets underwritten once up front. Every year they don't have to submit new financials, personal financial statement, tax returns, etc. Makes it easier to do from an underwriting standpoint. You do have the prepayment penalty. They charge an origination fee that's a percentage of the total loan facility with a cap of 15 grand. That $15,000 is charged once. It can be capitalized into the loan if they want to do that.
He was charged 15 grand.
Yeah. It's not a bad deal. I've heard that the rates I'm getting from that lender are below street rates. Actually, I sat with the executive vice president of the bank right behind me in this chair right here a few months ago, and talked about rates. And I said, "Come on, you got to be more competitive than that. The rates are not always the rates. Depends who you're working with, how much volume we do, the nature of the relationship with the bank, et cetera, et cetera."
The financial markets. I mean, I working with clients all day long, we can sense, investor sentiment, client sentiment, and I'm hearing the same thing over and over again. Clients are scared. Clients are, their eyes are like, what the heck is going on, right? And so if someone's fortune has changed and they don't requalify, what happens?
The qualification on loan underwriting is really more about the strength of the product and the carrier, right? Because that's by securing the deal, and the outside collateral. So if they need to post whatever $2 million in outside collateral, and the guy's worth 50 million bucks, and he's got 20 million in liquid, doesn't matter.
Right.
If his 20 million becomes worth 15 million, it still doesn't matter as it pertains to the policy and the collateral, right? So it's really not a big deal. Where it's a big deal is where they're cutting it too close, where they have to post 2 million in collateral and they have 2.3 million in total liquid. And then all of a sudden the market takes a hit. And now their liquid's 1.8. And they're going to get a collateral call the next year and they're going to be short. That's a problem. That's a major problem. Here's why, for the right client, I like using real estate equity as collateral. Okay, so let's say a guy's got a $10 million piece of real estate. And so the two different lenders that work very similar in this regard. They discount the property value. So they get appraised. They discount it 35%. So that's 6.5 million. Let's say the property has 3 million in mortgage debt on it. 6.5 million minus that 3 million, they got 3.5 million in equity left over. If the client only needs, say, 2 million in collateral, well, they got 3.5 million in real estate, right? How much is that real estate going to take a hit in a day or even a year, right? It doesn't happen like the stock market. So they're over collateralized each year when they do the collateral check. They're so over collateralized that nothing really changes all that much. So from an underwriting standpoint, the lender says, okay, so the guy had a crappy year. He lost money on his tax return, but he hasn't defaulted on his interest payments. And he's got the real estate equity that's double what we need in collateral. Policy's chugging along just fine. No problem. So it's not a big deal. It's a big deal when they're cutting the collateral too close. It's all about liquidity and collateral. That's the name of the game in premium financing.
I'm seeing it. No, for sure. It's liquidity and collateral. And if they're cutting it close.
Yeah. It's the greed of the agent, and it's the greed of the premium financing intermediary that pushes the client into something that the client really cannot truly afford. Like, they can afford it today from a cash flow perspective, but they can't afford it from a risk perspective because they're not liquid enough. An example I use often, hopefully you'll take this as being self-deprecating, not being
I know you're badass. It's okay. If you know you're badass, it's okay.
years ago, I bought a Ferrari 358 Ferrari. It was purchase price was $279. I put down 79 grand, and my monthly payments were like 3,100, right around there. And I could, quote unquote, afford it. And I drove that car for about a year. And then all these forums started popping up. Ferrari's coming out with a 488 up from the 458. And it was going to be the first twin turbo that Ferrari had ever done. I don't know if that means anything to you, but it's a different method of, it's a different deal. So my car, when the new model came out, was either going to greatly appreciate in value because my car would have been the last naturally aspirated Ferrari engine. So it could go up in value, or it could plummet in value because maybe everyone wants the new twin turbo and no one wants the old school version. I was not in a financial situation to absorb the risk if that value of that car plummeted. So there was that. Then there was the aftermarket warranty. The aftermarket warranty, I can't remember, it was 10,000 or 15,000, and it only covered a year. So I'm at the maintenance Ferrari shop in Newport Beach. I go, is it worth, just be straight with you, is it worth it? He goes, put it this way. You see this little plastic switch on the dash here? He says, there's something that below that switch that goes to this and this and that. And we just had to replace it, which meant we had to go into the whole thing. And just replacing that little switch thing right there, that alone was $10,000. I'm like, okay, I'll buy the warranty. So shortly after I bought the warranty, which is non-transferable, by the way, and then they announced that they're releasing the 488. I thought, man, I'm not rich enough for this. This was, I'm not the guy that's got, 10 Ferraris in his garage. I got a Suburban that I drive every day, and I got my Ferrari. I was not suitable. I was not wealthy enough and not liquid enough, in my opinion, in retrospect, to be a Ferrari ownership at that time. So again, that's an example. Yeah, I could afford the down payment. I could afford the monthly. I could afford all that. I could even afford to buy the stupid warranty, but I could not afford the risk of the value of that car plummeting. And then what am I going to do? So I got out and I sold it.
Like, yeah, it's, can you afford the payments versus can you really afford to, a house, right? Maybe you could afford, X amount of house from a payment perspective, a down payment, but can you really afford the maintenance, the upkeep, what it takes to really put that house, how it should be lived in, et cetera. Yeah, no, so I totally get it. So I so appreciate this conversation from so many perspectives, but he scared me. He's got $1 million Mass Mutual premium finance with me. And we actually used another policy that I had sold him as collateral for that policy, which has worked great. He keeps feeding that policy, and that policy is the collateral for his premium finance. The tricky part is going to be his interest rate is going to go up, no doubt, with his mass policy. And it's also gone up over here. So his liquidity is tighter. He has a greater collateral call here. He's got really high interest rate here. And now he's got the other policy in terms of interest. So he's going to be able to do it. He ain't happy. He's very happy with me. He's not happy with the other guy. Thank God. But that unhappiness can transfer as you know, they can project their unhappiness.
Yeah.
So,
Yeah. Literally, right before I got on the Zoom call with you, I was on the phone with an advisor and his client. His client's an attorney, and he's worried about borrowing interest rates going up, right? Which I get. So we get on the Zoom, and he's a little fussy. And I said, look, the whole premium financing proposition to have this work over time from a mathematical standpoint is you're trying to eke out just a little bit of arbitrage over time. That's what makes the leverage work. So I said, look, what I did, I went back to 1982, ran the clock forward 40 years, which takes us to the end of last year, 2021. In 1982, prime was 11%. One of the lenders that we use uses a prime-based loan. They go prime minus 1.6. So in 1982, if you were to use that lender with that lending proposition, the borrowing rate would have been 9.4%. So imagine getting into premium financing today if the borrowing rate was 9.4%, right? You think interest rates are high today? It ain't 9.4%. But what I did was I matched up 1982's borrowing rate using that method with 1982's S&P return and assumed a 10% cap. And then I ran the same correlation between 1983's borrowing rate and 1982's S&P rate, 1984, boom, 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 all the way up to 2021. The average positive arbitrage between the borrowing rate and the crediting rate, starting out with the borrowing rate was north of 9%, the positive arbitrage was 2.10% over a 40-year period. The internal rate of return, cash on cash, during that period that started out 3 years in a row, 1982, 83, 84, the borrowing rate would have been higher than 9%. The IRR was about the same as illustrated in the carrier illustration, assuming today's borrowing rates, and was better than the worst 40-year period that we analyzed, assuming today's borrowing rates and an increase in borrowing rate. So I say all that to say, look, the borrowing rate alone is not the thing to look at. The thing to look at is the relationship between the borrowing rate and the crediting rate over time.
well, it is from the yes, I totally can see how that would be the case. The difference is a client who's got a $10 million loan, who's got to pay interest at 9% versus 4%. However, if interest rates are 9%, he might be earning on his investments, a higher. So it's relative. It just is breathtaking today when interest rates were 2.5% last year. And if you owe $10 million, you're making a payment of $250. No big deal.
Yeah.
For everything else you're getting. But in comparison, you're like projecting, oh, if it was 9%, oh my gosh, right? So it's all relative.
Yeah. The danger is if the client does not have the liquidity or the cash flow to pay the higher interest payment, that's where they run into trouble. But I would say that if the interest payment went from 400 grand a year to 600 grand a year, 200,000 a year is nothing for the right client that should be doing premium financing in the first place, right? If they're wealthy enough to do premium financing, 200 grand a year is nothing. It's just nothing, right? But if they're not that wealthy, like I was not wealthy to afford the risk of the Ferrari, if the client's not wealthy enough to afford an extra 200 grand a year in interest payment,
he shouldn't be in this.
That client should not be doing premium financing, or at least shouldn't be doing as large a policy in a premium financing arrangement.
Yes. Okay. Got it. Are you familiar with the programs that are doing lower income, professional plus middle income, lower income from a premium finance case that's doing more of you pay a couple years worth of premium until policy and then you get a line of credit. Are you familiar with that?
I know exactly the one you're talking about. Yep.
Okay. Any thoughts on that?
I applaud the creativity. I would have concerns that the demographic that program is being marketed to does not have the liquidity to absorb the risks that we just talked about. So here's how closely acquainted I am with this. Okay, so we designed a program similar to that, and the intention was to market it to doctors, specifically doctors like cardiologists, as an example. So not a general practitioner that's making 200 grand a year.
Right.
Cardiologists,
$1 million.
plastic surgeon, yeah, guys are making 600,000 to $1 million a year. And even in the pandemic, I didn't see plastic surgeons or cardiologists out in front of their clinic with a cup in their hand, right? It's a very stable type of industry.
Those women are still getting their Botox shots.
Yep. So that's very different than, say, a small business owner that's manufacturing widgets, making $600,000 to $1 million a year. Something happens, that guy could be out of business, right?
Yeah.
So this happened with us with that program. Small business owner making 500-600 grand a year. His commitment was 50 grand a year for 10 years. Okay, easily could afford it cash flow wise. He's like year 3 into the deal or so with us, 3 or 4 years into it. Pandemic hits. Business goes out of business. Comes and says, I can't afford my 50 grand. What are my options? So, okay, well, as a short-term band-aid, we could accrue all the interest in this year, or you could just not fund the policy for a year and try to play catch up later. It's not ideal. It's going to affect your cash value, et cetera, but it's not like you have to surrender your whole policy.
Right.
At least you have a temporary band-aid we can put on it. He says, that sounds great. So that particular setup was, he's funding 50,000 a year for 10 years. Year 1 and 2, the premium's 50 grand, non-financed. Year 3, he borrows, I think it was like 250 or 275 or so, something like that. Pays into the policy. Some of that covers interest. Some of it covers principal. So I go to the lender. I said, hey, our client, he's struggling cash flow wise. Can he accrue the interest this year? He said, yeah, no problem. Let us do the collateral calculation. So in this setup, the collateral was very low. And in many cases, it's 0 because the borrowing doesn't start till year 3. All right. So the policy has 2 years of premium going in unencumbered with no debt on it. Lender comes back, says, okay, he's got to put up 5 grand in collateral. 5 grand. It's like $5,300 or something like that. That's fantastic. Woo! Go back to the client. Good news. You can accrue the interest. You don't need to put in 50 grand this year. You just got to post 5 grand in collateral. You know what he says?
I don't have it.
I don't have $5,000. Now, don't get me wrong. I felt bad for the guy, right? His business is struggling. He's struggling personally. I felt bad for him. But what are you going to do? You got to put up 5 grand. Guy throws a fit. And that was the last time I have ever tried to market that low a premium financing design to that type of entrepreneur with that type of liquidity and income. See, if that guy had, a couple $1 million in liquid and he had a bad year and couldn't afford 50 grand and didn't want to pull 50,000 from his brokerage account, no big deal, right? Post 5,000 of your $1 million brokerage account and give yourself 12 months to figure things out. No problem. But that guy didn't have any liquid.
So the program, as I understand it, is in that example, the client put up 100,000, 50,000 a year. In the 3rd year, the policy is being collateralized for a line of credit, and that line of credit will pay 3rd year, 4th year, 5th year, 6th year premiums. And there's no interest out of pocket, and there's no collateral out of pocket.
If we're talking about the same program, don't say the name just because we're recording it, but what I've seen is it's a $50,000 in this example, $50,000 annual commitment for 5 years. The premium is actually 100 grand. So they're paying half of the premium in years 1 through 5. They're borrowing the other half of the premium in years 1 through 5, and they're accruing all the interest.
Oh, it's still being recorded.
Yeah, don't say it, but write it down and put it on camera.
I know, silly, right? I'm thinking audio recording. I've got 2 minutes. I want to say, number one, I appreciate your time and your I have a level of comfort with you because you practice defensively, which is how I practice. I see what can go wrong possibly, and I err on the side of caution.
Right.
And I protecting myself, protecting the client. My client 3 years ago said, "Sell me a $1.3 million policy," and I said, "No, I'm not doing an IUL. I'm not doing that. I don't know it well enough to protect you." So that's how I operate, and I like having a partner, a colleague that has that mindset, and not, I'll shoot first, then I'll aim later.
Yeah, right.
And clean it up.
Right.
Right. And you've got the math, and I don't know how comfortable I feel with an IUL. I would probably feel more comfortable doing a mix. Maybe, hey, we know at the very least this is what whole life is going to do, and we can do a percentage of IUL. Like, I'm not sure what that would look like. But my plan is
you can certainly do that. And I mean, it's not like I'm against financing whole life. We finance whole life.
right.
It's not the majority of the business that we do, but if for the right client that likes that product design better, financing whole life is great.
Yeah. So I will be reaching out again, but thank you so much for your time today.
Very good. Very good. This would have made a great podcast. Could you send me a copy of the recording?
Sure.
I'll chop it up, edit it, and then I'll send it to you before I do anything with it.
Make sure you make me look smart, not silly.
Yeah, yeah. Maybe I can block out the screen when you do that. That's funny. Oh my God, that was classic. Yeah, if you can send me the link to the video, that'd be great.
I will do that. Thank
Cool.
you so much.
Great talking to you. Okay.
Bye-bye.
Bye-bye.